Zach's Rank Buys, stocks with a short-term buy or strong buy recommendation. Now, here are more Zach's Rank Buys. A couple of old line companies topping our list of growth and income stock picks this time around, and Todd Bunton, our growth and income stock strategist, is back to give us a read on these two companies and why he chose them as his top growth and income picks. First one's Caterpillar. CAT, the ticker. That's a well-known name.
Yeah, very, very well-known brand. Global brand now. They reach all across the globe, famous for their big yellow earth-moving machines. They do construction and mining equipment. They have diesel engines, things like that too. But as you can imagine, with the growth in the emerging markets, the BRIC countries especially, that's really been driving sales and earnings for them as they build infrastructure, they build homes, they build roads, all of these things. It's spurred demand for CAT's products, and it's led to a string of solid earnings per share beats. But it's not just growth in the emerging markets; it's growth here in North America too. They've seen over the last couple of years, and that really speaks to the health of the economy. Not that it's booming by any means, but actually management they issue really in-depth guidance on the economy, not just here in the U.S. but globally, and they mentioned that they continue to see an economic recovery going forward, albeit a slow one. But
in their part of the economy anyway.
Yeah, exactly. Yeah,
in the part that they service.
Absolutely, but that they are sort of an economic bellwether, so that's kind of a good read for not only our economy but the global economy. Now, of course, with the problems going on in Europe right now, if that spreads over to the rest of the globe, that could, if it sinks the economy around the globe, then Caterpillar they're very economically sensitive, so they'll definitely feel the brunt of that. But so far, so good. And if you take a look at the price and consensus chart, you can see analysts have been consistently raising their estimates over the last several quarters. The company delivered a solid earnings per share beat in the third quarter. And a lot of that has to do with leverage. So they're a manufacturing company, meaning they have a lot of high fixed costs. So a decent rise in sales can lead to a tremendous rise in earnings per share. But like I said, that's kind of a double-edged sword. If the economy slows down, then they're going to see a huge drop in earnings per share and probably a drop in share price. So that's the risk you have here with Caterpillar. But like I said, so far so good. Analysts are expecting 66% earnings per share growth this year, 33% growth next year.
Good dividend history.
Absolutely, yeah. So you're getting income as well. Pay dividend that yields 2%. And they've raised that consistently over the last decade, about a 9% average annual rate since the year 2000. And you're getting it at a great price. They traded about 11 times forward earnings. That's a discount to their 10-year median of 14 times, and their PEG ratio is right around 0.5. So there's a lot of upside potential here. Like I said, if the economy continues to at least kind of muddle through growth, sluggish growth, it could still benefit Caterpillar very well.
Okay. The Timken Company, TKR, the ticker symbol, is that other old line company, manufacturer also.
Yeah, they manufacture bearings, alloy steel, mostly for the automotive, industrial, and aerospace markets. Again, it's a very cyclical name. If you plot the share price of Caterpillar to Timken, I did that recently. Over the last 5 years, you can see it's very highly correlated. So they definitely depend on the economy like Caterpillar does. But they've been around like Cat for forever. Timken was founded in 1899. They've been on the New York Stock Exchange since 1922.
Wow.
But they've been benefiting from global economic growth as well, and that was on display in the third quarter. The company delivered a solid earnings per share beat, solid sales growth, and management raised guidance for the remainder of the year. That prompted analysts to raise their estimates going forward, and they expect strong growth from Timken as well. Based on consensus estimates, they're expecting 55% earnings per share growth this year, 14% growth next year. And again, that's based on the premise that the economy is going to continue to grow around the globe. But you're getting growth there. You're also getting income. They pay a dividend that yields 1.9%. Now, they did cut that in half during the Great Recession, but they've raised it 3 times since early 2010, so that's definitely moving in the right direction. As long as earnings grow, I don't see why they wouldn't continue to increase that in the future. And you're getting Timken at a very great price right here. Again, if it all depends on what happens in the Eurozone, if that spreads to the global economy. But like I said, if the economy continues to move forward, it's a great price, a lot of upside potential. They trade at 8 times forward earnings. It's a discount to the industry average of 11 times, and its PEG ratio is also 0.5. So there's a tremendous upside potential here.
1800s, boy, that's about as old line as you can get.
Yes.
Do you own either of these two?
I don't.
All right, we have other stock picks for you on our website, on the homepage, zax.com. If you're not there already, you want to get over there and check them out. There are 4 new picks up each trading day, one in each of the investing categories that we write about, Todd's included. With Todd Bunton, I'm Terry Ruffalo.